5 tips to help you become a successful mutual fund investor. Number 1, assess goals and choose schemes. Mutual fund investing is not rocket science, but there is some logic to how you invest. You should never choose a fund based on its expected returns or the returns it has previously generated. This is one of the primary reasons why investors end up investing in funds that do not match their risk tolerance. As a result, when the fund exhibits unexpected and sudden movement as well as an adverse effect on returns, investors tend to withdraw from the fund. As a result, if you are a true investor, you should invest for the long term, and you should choose your schemes based on your financial goals and risk tolerance. You will avoid the panic caused by volatility and be able to enjoy trouble-free periods of growth. Number 2, get involved. As a mutual fund investor, you will discover that the equity markets, particularly the stock market, are volatile. It is impossible to predict market movements without some level of knowledge. Most investors devote insufficient time to mutual funds, believing that they have gained sufficient knowledge. The idea is that you should try not to time the market, but rather spend enough time in it to gain a better understanding of assets, particularly equities. Furthermore, if you intend to make a lump sum of investment or wish to add to existing investments, do not invest all your wealth at once. Make gradual, staggered investments. Number 3, learn about momentum investing. Momentum investing seeks to profit from existing strong trends. Momentum investing is closely associated with a growth investing strategy. The weighted average price earnings to growth ratio of the fund's portfolio holdings, or the percentage year-over-year increase in the fund's net asset value, are metrics used to assess the strength of a mutual fund's price momentum. Appropriate mutual funds for momentum investors can be identified by fund descriptions in which the fund manager explicitly states that momentum is a primary factor in his selection of stocks for the fund's portfolio. Investors who want to track market momentum through mutual funds can examine the momentum performance of various funds and make fund selections accordingly. A momentum trader may seek funds with accelerating profits over time, such as those with net asset values that are increased by 3% 3 years ago, 5% the following year, and 7% in the most recent year. Momentum investors may also look for specific sectors or industries that show clear signs of strong momentum. After identifying the most promising industries, they invest in funds that provide the best exposure to companies operating in those sectors. Number 4, master the contrarian investing. Contrarian investors invest against the current market sentiment or trend. A classic example of contrarian investing is selling short or avoiding buying an industry stocks when almost all investment analysts predict above average gains for companies in the specified industry. To summarize, contrarians frequently buy what the majority of investors sell and sell what the majority of investors buy. Contrarian investing is similar to value investing in that contrarian investors typically buy stocks that are out of favor or whose prices have fallen. Contrarian trading strategies, on the other hand, are driven more by market sentiment factors than by value investing strategies and rely less on specific fundamental analysis metrics like the price-to-book ratio. Contrarian investing is frequently misunderstood as simply selling stocks or funds that are rising and buying stocks or funds that are falling. But this is an oversimplification. Contrarians are more likely to go against popular opinion than they are to go against popular price trends. A contrarian move is to invest in a stock or fund whose price is rising despite widespread market belief that it should be falling. There are numerous mutual funds that can be labeled as contrarian funds. Investors can look for contrarian-style funds to invest in, or they can use a contrarian mutual fund trading strategy to choose mutual funds to invest in based on contrarian investment principles. Contrarian mutual fund investors look for mutual funds that hold the stocks of companies in sectors or industries that are currently unpopular with market analysts, or they look for funds that have underperformed the overall market. A contrarian's attitude toward a sector has been underperforming for several years, maybe that the prolonged period of underperformance only increases the likelihood that the sector stocks will soon begin to experience a reversal of fortune to the upside. Number 5, diversify. The benefit of mutual funds is that they contain a variety of asset classes. Because the risk associated with each is different, these take on different investment approaches. Investors frequently make the mistake of putting all their money into a single type of asset. This increases risk while limiting growth. Diversifying a portfolio is central to successful investing. This means that investors should allocate their wealth to various types of funds or asset classes. This combination guarantees both growth and a stable investment. You can diversify and choose different asset classes based on your specific goals. If you believe you have a complex diversification, you must review your funds on a regular basis. It is necessary to keep track of where your funds are going at least once every 6 months. If you discover that your fund's performance is not up to par, lagging behind peer funds, you may want to consider a mutual fund switch. Now is the time to make a change in your investment. To accomplish this, you should always choose mutual funds to invest in online so that you can easily monitor them. The most successful mutual fund investors ignore myths and instead rely on specific aspects of investment knowledge when investing. If you want to be a successful mutual fund investor, you should not overlook the following 5 tips.